Good morning, good afternoon, good evening. Wherever you are joining us from, you are most welcome here to attend a great session that we are going to host today on taxation and different asset classes when it comes to investing from India. We have today a very resourceful and a fairly known name with us, Mr. Balwant Jain. He's been a chartered accountant by profession, and most of all, he's been a CFP professional since 2013. Mr. Jain has been running his own proprietary firm since 1984. And prior to that, he's had a good spread of corporate experience working with different kinds of companies, retail, NBFC, and the such. Other than matters on taxation, Mr. Jain is also very active in making sure that he spreads his knowledge through many medias, including the chat box that is operated out of the Money Control platform. And he addresses many issues related to investments and taxation. Without further ado, let me welcome Mr. Jain and hand over the floor to him. Very, very glad to have you today with us, Mr. Jain.
Thank you, sir. Thank you very much.
So today, Mr. Jain is going to take us through an understanding of various asset classes and the taxation connected to it. And, we would reserve the last segment of the conversation for questions. So please hold on until then. Over to you, Mr. Jain. Thank you.
Thank you very much. So, good morning, good afternoon, good evening, as the case may be. Thank you, FPSB, for inviting me to give a little bit of what I know about various asset classes and the tax implications. I would deal with the taxation aspect rather than going into the details of the various asset classes. We will discuss broadly taxation aspect of 4 asset classes, starting from equity, where I will include Indian equity as well as the international equity, fixed asset products like FD, bond, GSEC, and mutual funds, real estate, and commodity. Under the commodity, I will discuss the taxation aspect of 2 major investment products under bullion, gold and silver. So before I go to specific asset class, let me explain you some of the provisions of capital gains which are applicable to almost all the asset classes. So let us start with the case where an asset comes into the possession of a person by way of gift or inheritance. In such case, how the cost to the person is to be computed. So in case you become the owner of any asset through gift or inheritance, the cost of acquisition for you is not nil, as many people perceive it to be. For the purpose of computation of capital gain, the cost which was incurred by the previous owner who had paid for is your cost. And in case the asset was acquired prior to 1st April 2001, then the fair market value as on that date can be taken as your cost of acquisition, and then you can apply the indexation benefit for computation of capital gain. The Income Tax Act has a provision of giving rebate to the marginal taxpayers under section 87A. So 87A grants relief from tax payment to the individual taxpayers whose taxable income does not exceed 5 lakh in a year. Mind, it is the taxable income and not the gross income. So in case your income does not exceed 5 lakh, you are entitled for a tax rebate of 12,500. this rebate of 12,500 is available against all your income, whether it is your salary, business income, income from other sources. As far as capital gains are concerned, you can claim this rebate against capital gains of all nature, except the long-term capital gain on equity products. So if you have a taxable income, long-term capital gain under listed equity shares or equity-oriented units, then you cannot claim this rebate of 87A. And even if your taxable income is less than 5 lakh, you still have to pay tax on your taxable portion of long-term capital gain on equity. For individual taxpayers and HUF, tax laws allow you certain deductions like under section 80C up to 1.5 lakh, or for mediclaim 25,000 for yourself, 25,000 for your parents, and in case parents are senior citizens, it is 50,000. So against this long-term capital gain of any nature and short-term capital gain on listed equity shares, you are not entitled or eligible to claim deduction under section chapter 6A. So in case your income exclusively includes this, then you, even if you have paid eligible amount under section 80C, you will not be able to claim the deduction against your taxable capital gains. The tax laws also allow resident taxpayers, mind it, it is available to resident taxpayers to adjust the shortfall in the basic exemption limit in case your taxable income includes only long-term capital gains or short-term capital gain on listed shares. Then, and if you are a resident, then you are eligible to reduce your taxable long-term capital gain and short-term capital gain by the amount of basic exemption. And in case there is any other income, but it does not exceed basic exemption and it is below the basic exemption, then a resident taxpayer is eligible to adjust the shortfall against the taxable long-term capital gain and short-term equity capital gain. For long-term capital gains of any nature, tax laws allow you exemption provided you make investment in a residential house or you buy bonds, capital gains bonds. So if you have sold a residential house, then the exemption is available under section 54. And in case of a residential house, you have to invest in a residential house, and the amount of investment to be made is a taxable index capital gain. In case you have sold any asset other than a residential house, then you can claim rebate under section 54, but here you have to invest the net sale consideration and not the tax index capital gain. The house has to be purchased within a period of 2 years from the date of sale of the asset, or even if you have bought a house within 1 year prior to the sale of the asset, you can claim the deduction. In case you go for an under construction property or go for a self-construction, you get an extended time period. And in case you are not able to utilize your capital gains by due date of filing of the returns, you have to invest the unutilized portion in the capital gains account scheme with the banks. As far as section 54F is concerned, for capital gains on other than a residential house, you can claim this only and only if you do not own more than one house, except the house which you are contemplating to buy. In addition to the investment in residential house, you are also allowed to claim exemption under section 54 EC by investing in specified capital gains bond up to 50 lakhs every year. So here, whether your capital gain arise from the residential house or any asset other than a residential house, you have to invest just the capital gain and you can claim the exemption, but there is a ceiling of 50 lakhs beyond which you cannot claim exemption in respect of one transaction and during 1 year. Let us come to equity products. So there are many avenues for investing in domestic equity as well as foreign equity. As far as domestic equity is concerned, one can go for direct equity investments or take the route of mutual fund, investing in equity through mutual funds. Then there is PMS. There are some employees who get ESOPs from their employer, and there is a option of investing in alternative investment fund, AIF. And people who wish to take global exposure can either directly invest in shares of foreign companies, or they can also take the route of mutual funds, foreign mutual funds, or through ETFs. As far as taxation of domestic equity is concerned, the income comprises two parts. One is a dividend and other is the capital gains. So as far as dividends are concerned, the dividends for resident taxpayers are treated like any other income and is to be included in your regular income and taxed at the slab rate applicable to you. But for resident taxpayers, non-residents, the dividends are taxed at a flat rate of 20%, irrespective of the slab of the non-resident. As far as the foreign dividend is concerned, it is included in your income. And in case you have paid any tax in the foreign country, you can claim the tax rebate in respect of the tax paid for that income in foreign country. The second portion is the capital gain. So here we will divide the equity investment in two parts. One is the listed equity and the equity oriented scheme, where the separate provisions are there, and then there are unlisted equity, or where the provisions are similar to foreign investment. So in case you invest in listed equity shares or directly, or in equity oriented schemes indirectly through mutual fund, your investment becomes long term after 1 year. And if you sell the shares before completion of 1 year, the profits are treated as a short term. Long-term capital gains are taxed at a zero rate up to 1 lakh, and beyond that it is taxed at a flat rate of 10%, whereas short-term capital gain on listed equity shares are taxed at 15%. So the listed equity shares and equity-oriented schemes will qualify only and only if a security transaction tax has been paid at the time of purchase and sale in case of listed equity shares, and at the time of redemption in case of equity schemes. In case you had acquired those shares or equity mutual fund schemes prior to 31st January 2018, then the tax laws allow you to take the fair market value of your investment in shares or mutual fund as on 31st January 2018 as your cost, and then calculate your taxable capital gain. Normally, for long-term capital, computation of long-term capital gain, taxpayers are allowed the benefit of indexation, but the benefit of indexation is not available in case of a direct equity or listed equity or equity mutual funds. In case you have made investment in equity through SIP in mutual fund, because normally people invest in equity not in lump sum but in a staggered manner through either SIP, systematic investment plan, or systematic transfer plan. So for the purpose of taxation of SIP, each investment of your SIP is treated as a separate investment, and each installment of SIP has to complete 1 year to qualify it as a long-term So since long-term capital gains on listed equity shares are exempt, or rather these are not exempt, they are taxable, but they are taxed at the zero rate. So it is always advisable to book minimum of 1 lakh of long-term capital gain on listed shares or equity units every year in income tax file of all the family members to optimize your overall tax rate. There are many investors who are facing the staring at the loss of shares which are no longer traded on the stock exchange. I receive a lots of mail asking for what can be done. So as long as those shares which are unlisted, delisted by the stock exchange, are lying in your demat account, you cannot do anything about it. But in case the company has gone for liquidation or for a bankruptcy, and the tribunal sometimes orders for the extinguishment of the existing shares. So under the income tax law, any extinguishment of a right is also treated as a transfer, and you can claim loss in respect of delisted shares. So, but if in case the shares are lying in your demat account, you cannot claim the loss. So in order to claim loss in respect of those delisted shares, what you can do is you can transfer those shares to your any of your friend or relative at a very nominal price to book the loss and claim the loss in your income tax returns. As far as a buyback of shares by companies, listed companies is concerned, any profit which the investor makes on a buyback, like recently people who had tendered shares in TCS buyback, the profits are tax exempt because the company is required to pay tax on the amount utilized for a buyback. Next we take the unlisted equity shares or foreign equity investments. So the unlisted equity shares become long-term after a period of 24 months. But unlike profit on listed shares, here you are allowed to take the benefit of indexation to reduce your tax liability. Any short-term capital gain made on unlisted shares or foreign investments is treated like your regular income, and it is added to other income and gets taxed at the slab rate, whereas the long-term capital gains are taxed at a flat rate after applying the indexation benefit. As far as lots of people, especially the startups, give their employees stock options as a reward and inducement to stay with the company. So the stock options are taxed at 2 stages. When the company grants you an option, there is no tax liability. But when you exercise the option, then the difference between the exercise price and the fair market price of the share is treated as a perquisite and the company deducts tax. And the second stage is when you actually sell the shares, then the difference between the sale price and the exercise price is treated as a capital gain, either a short term or a long term, depending on the holding period. So, but it is not that in case of all ESOPs, the perquisite gets taxed at the stage of exercise. So income tax laws allow employees of a certain qualifying startups to defer their tax liability on perquisite. So in case of a qualifying startups employee, the employee does not have to pay any tax immediately at the time of exercise, but he has to pay this tax on this perquisite at the happening of any of the three events, earliest of the 3 events. So the maximum time which is allowed is the 48 months from the end of the year in which the exercise option is exercised. Or if the employee sells those shares before 48 months, then the perquisite, it has to be treated as perquisite and taxed. And even if the employee does not sell the shares and he leaves the company before completion of 48 months, then at the time of cessation, the employer has to deduct tax within 14 days of this event happening. As far as the taxation of PMS is concerned, in case of PMS, the shares are held in the name of the investor only. And the dealing is done in the demat account of the taxpayer. So it is for tax purposes, it is nothing but as if he himself has done all the transactions. And generally, these are taxed as capital gains. However, there is a rare chance of it being taxed under the business income if there is a huge volume and the holding period is relatively short, or it has been done with the borrowed money. There are various factors, and no specific rules have been prescribed about when it will get taxed as a business income or when it will get taxed as a capital gain. But in majority of the or a significant number of cases, because the one goes for PMS for wealth creation and not for distribution of income, so it has to be get taxed as a capital gain. The person who opts for a PMS has to pay the PMS manager either a fixed fee or a variable fee or a hybrid model of the fee. So as per the income tax law does not provide for deduction of any amount which you pay to the PMS manager as a fee against your capital gains. Then there are alternative investment funds. There are three categories of alternate investment funds, but since the subject is very delicate and it is not easy to deal with it in this single slide, there are three categories of this AIF. First category is where the angel fund, social venture fund, SME funds, etc. are covered. And then then there is a third category, which basically try to do short-term trades, and they have a short-term strategy like hedge funds to earn the income for the investor. So any fund which is does not fall in this either first or third category is by default falls in the second category. The first and second category AIFs are pass-through entities, and any income which comes in the hand of the investor is taxable in the hands of the investor, whereas the third category of AIF are taxed. The income of AIF is taxed in their hands itself, and any income which comes in the hand of the investor is tax-free. Now let us come to the real estate investments. Indian have option investment. Traditionally, our forefathers have been investing in gold and real estate investment. And the other reason is that there were no sufficient avenues available for making investment in other products like equity or fixed rate products. One can make investment in land, commercial or residential property. So the tax laws treat the income, rental income, differently than the profit made on the sale of a real estate investment. So when if your property is let out, then you are allowed a standard deduction of 30% from your rent in addition to the municipal taxes. Additionally, if the property has been acquired or constructed with borrowed money, you are allowed to claim deduction of interest of full amount against your the 70% of the rental income. But there is a provision under the income tax law which caps the loss for a particular year under the house property head, which can be adjusted against your other income. So the law restricts the loss up to 2 lakhs to be set up during the current year. And in case your house property head has lost more than 2 lakhs, then the loss can be carried forward in subsequent years and can be set up against the income from house property. As far as self-occupied property is concerned, a taxpayer is allowed to have maximum of 2 properties as self-occupied house property. And if he has borrowed money for buying or constructing this property or properties, he is allowed to claim a deduction of up to 2 lakhs of interest. If the interest is higher, the higher interest, for higher interest above over 2 lakh, you do not get any tax benefit, unlike the let out property. The 2 lakh limit is not per house, but is for both the house taken together. If you have more than one, if you have 2 self-occupied house property, and if one has more than 2 self-occupied properties, then the taxpayer has to choose any of the self-occupied 2 properties as self-occupied, and the other properties are treated as if these properties have been let out, and you have to offer notional rent for taxation on those deemed to have been let out properties. For the money borrowed for buying property, if you have bought a residential house, then you can claim deduction for repayment of the money under section 80C. The deduction for 80C is not available for a non-residential property, or if the money has been borrowed from other than banks or financial institutions or central bank, state government, or a local authority, etc. So if you borrow money from your friends or relatives, you can claim the deduction for interest paid on that, but you cannot claim the interest for repayment of the loan taken from friends and relatives. Interest on the home loan we have already covered. In case the property is jointly owned, then as per the provisions of section 26, each joint owner is treated as a owner of that respective share, and each joint owner is entitled to claim 1,50,000 under section 80C and 2 lakh of the interest if it is self-occupied, and unlimited interest subject to the cap of set off in case it is let out. In case you have booked an under construction property and have borrowed money for that, you can start claiming deduction under section 80C for repayment as well as for interest from the year in which the possession is obtained by you, or for the interest which you have paid prior to the year in which the possession is taken or the construction is completed. You are allowed to claim the interest paid during this prior period, which is called pre-MI interest 20% each in the next 5 years, including the year in which you take the possession. As far as capital gains on real estate is concerned, the holding period requirement is 24 months. So in case you sell any property, whether it is land, residential building, commercial building, before 24 months, the capital gains are short term and taxed at the slab rate. But if you hold beyond 24 months, the profits are treated as long term and taxed at 20% after indexation, and you can avail the various exemptions also, which I've explained earlier. In case the property is acquired prior to 1st April 2001, You can substitute the market value as on 1/4/2001, but not higher than the stamp duty valuation as on that date as your cost. Short-term capital gains are taxed at the slab rate. Long-term capital gains after indexation are taxed at 20%, which I have said earlier. The exemption also I have already discussed on residential house as well as the any asset other than non-resident, which will include land and commercial assets. Now we come to fixed income products. So the major portion under the fixed income product is taken by the bank fixed deposit, where a person who does not understand anything, but he understands what the bank is paying on the deposit. So significant money goes in the fixed deposits in India. The fixed deposit only gives you interest. There is no chance of any capital gains, so there may be chance of you losing the money. So as far as the interest income on your fixed deposits is concerned, a taxpayer has the option to offer the income either on accrual basis year after year or at the time of maturity. But you have to use the option once exercised consistently, and you cannot change it in between as per your convenience. So in my opinion, people should go for a accrual basis, so that the tax applicable slab rate does not go up all of a sudden due to receipt of cumulative interest in the year of maturity. Bonds and interest are taxable under the head capital, under the head income from other sources, and the bonds and debentures offer you scope for capital gains, which is if it is not listed, then 20%, and otherwise if they are listed, then you have option of 10% without indexation. But bond and debentures are not eligible for indexation. But any other security which is listed on the stock exchange, except the units of mutual fund, you have the option of either paying 10% without indexation or 20% with indexation. There are various products of offered by a mutual fund, from overnight fund to GSEC fund, which has a period tenure of 7 years, 10 years, whereas overnight fund you can invest money for a single day. So you should invest the money in the mutual fund based on your time horizon. This portion we have already covered. As far as a holding period requirement for making your mutual fund investment long term is concerned, or even for bond or debenture, it is 36 months. So for listed shares, it is 12 months. For real estate, it is 24 months. But for the asset class which should be the most liquid, like your debt fund, the holding period requirement is 36 months. So if you sell your investment in mutual funds before 3 years, then the same gets taxed at the regular rate, your slab rate. You can, in respect of a debt scheme of mutual fund, you can claim the benefit of indexation. So if you want to put money, invest money in any fixed income product, then I would advise you to go for a mutual fund product rather than a fixed deposit, because the mutual fund products get you a benefit of indexation, and effectively the tax outgo is lesser. Moreover, the mutual funds offer you the benefit of a diversification, because the mutual fund, your investment, your money put in mutual fund, debt mutual fund gets invested across many companies. Unlike when you buy bonds of any specific company, the risk gets concentrated. There is no provision for TDS in respect of dividend which the mutual fund house pays to you, or even at the time of redemption. So this is cash flow positive for you in case of your bank FD or even bond or debenture interest, the TDS gets deducted, and to that extent you are short of cash. You may get a refund for your tax deduction, but temporarily you are cash negative to that extent. Now we have come to the last portion segment of our investment. There are many commodities to trade or invest, but traditionally gold and silver are used as a investment product, though the other products like crude etc are more like a speculative product and not investment product. For investing in gold, you have various options like gold jewelry, bullion, gold ETF, and its variation gold funds, where you do not have to have demat account and you can directly buy the gold units from a mutual fund. And the very recent entry is a sovereign gold bond, and which is most attractive. For investing in silver, you have to either buy utensil or silver bar. And very recently, the SEBI-permitted mutual fund houses to come out with the silver ETF, and there are 2 or 3 silver ETFs available in the market. As far as taxation of bullion is concerned, their holding period requirement is 36 months. And they are taxed at the short term are taxed at the regular rate, long term are taxed at the 20% after indexation. Sovereign gold bonds is a proxy gold product where you invest the money based on the gold price, and you are given a certificate. You are not given any gold. And when you redeem or when you sell the gold sovereign gold bond, you get the money equivalent to the price of the gold at that moment. So effectively, you are investing in gold, or you take the benefit of appreciation in the value of gold. Sovereign gold bond have a tenure of 8 years. These are listed. These are issued at various tranches by the RBI. When you invest in sovereign gold bond, you do not have to incur any expenditure for insurance or storage or having a demat account or fund management charges. And as an icing on the cake, you get the interest of 2.5% on the issue price of the gold bond. So while you save the cost of owning a physical asset or even electronic asset like ETF gold fund, you also earn interest of 2.5% on the issue price. So this is the interest on sovereign gold bond is taxable. Additionally, when you redeem, you get the price equivalent to the gold price in the preceding week prevailing in the market. So you get the appreciation also. As far as a capital gain on redemption of your sovereign gold bond is concerned, this is fully tax-free. So the RBI allows you redemption after 5 years, though the period is 8 years. So twice in a year, you are allowed to go for make request for redemption. So if you redeem these gold bonds, sovereign gold bonds directly through RBI, the capital gain bonds are, the capital gain is fully tax-free. These bonds are listed on the stock exchange also. However, the exemption from capital gain is not available in case you sell your the gold bonds on the platform of the stock exchange. This exemption of from the capital gain, whether it is short term or long term, is available to you whether you have originally subscribed to this bond or you have bought those bonds from on the platform of the stock exchange. So in case you want to invest in gold, you should opt for a sovereign gold bond, because you do not have to incur expenditure. The capital gains come tax-free in your hand, and additionally you get 2.5% of interest also. So this is what I had to say all. Thank you.
That was great, Balwantji.
Thank you.
I was going through your slides, and I was also reminded of a recent column that you wrote in Mint, a fairly elaborate one, which covered almost all the questions around the new tax regime.
Oh, I wanted to share it with, it is published today. So I normally share it on working days with the people in my broadcast list.
Yes. And I mean, that also brings with it, a lot of clarity on this matter. And so for those of you who are tuning in on this webinar, please also search for Balwantji's column in Mint, which talks about the new tax regime. Balwantji, so far as we are concerned, many of these matters that you shared today, it kind of touches everybody's lives on a day-to-day basis. And the kind of roundup that you gave on each of the asset classes, that was, kind of perfect in making sure that the common man is able to understand, what are the provisions against each of those asset classes. One interesting thing that you did talk about is on the SIPs and the STPs. And it is so much of a common, I guess it's more of a mistake or a lack of understanding that every single installment, therefore, kind of brings with it that much extra holding period. Many people think I started 10 years ago, so now everything on that investment is now 10 years old.
Yes.
All right. So that was a great piece of advice to the youngsters who are also building up their SIP book, their STP book. It's a great piece coming in. Balaji, just one more thing, just out of curiosity, one of the questions that came up was, although it's not specific to an asset class, but at least it's connected to the fixed income slide that you shared. For the senior citizens, the government has tried to simplify the whole tax filing and taxation. If their only source of income is either pension and or interest income from their FDs. So is there anything that you would like to throw light on? I mean, on that aspect?
So I feel that this scheme, which will become effective from this current financial year for ITR filing, will be a non-starter, because the condition prescribed is that the senior citizen should be in receipt of pension, plus his source of income should be the interest from that bank only. I have to yet come across a single senior citizen who has banking account with only a single bank. So I don't think it will be a starter.
Oh, okay. I mean, so which means the strict interpretation there is that you will, if you need to avail of that scheme, then you will have to consolidate every single investment of yours in fixed deposits into one particular bank.
Yeah, so your pension should be from the same bank where you are maintaining your all FDs and your saving bank account and your senior citizen saving scheme. And even that there are people, senior citizen, because the interest rates were very low. So people used to invest in this very senior citizen friendly product like senior citizen saving scheme or Pradhan Mantri Vay Vandana Yojana. So I don't think, even if the senior citizen is covered in the tax filing net, then he is not covered, definitely covered in this so-called 75-year plus senior citizen tax filing exemption scheme.
I see. Maybe there is a scope to leverage some technology and help all the senior citizens, reduce
So in case the government modifies it and makes it applicable, even if your source of income is from other places, and the senior citizen produces documentary evidence of his income from other banks, etc. And then the banker, the pensioner banker, allows you to accept your filing. So basically, this is not exemption. This is outsourcing of income tax return filing for those senior citizens by the bank. So bank in turn will have to upload those records, and bank has to collect the relevant documents from the senior citizens. So it is unnecessary burden for the bank without any remuneration they getting on it.
I see. Pretty interesting. So we need to keep watching out for these. And then obviously there is also a whole lot of conversation, and we covered this in our previous webinar around certain asset classes which are not regulated. These unregulated asset classes also can end up giving you hopefully they give you some income, and if they do, then there is a taxation on that too.
So I would like to warn the listeners not to go for any product which is not regulated. Yes. Be it, so you must have seen the cheat funds and people, the plantation schemes, and even I have reservation about the cryptocurrency also, because it is neither backed by any physical asset, nor it is backed by any sovereign guarantee. So, and then if it is an investment product, it can't be so volatile. So it is a speculative product.
Yeah. So I mean, which is also the reason why I noted on your slides that category 3 AIFs aren't allowed full pass through.
Yes.
Basically, if you are having such kind of extreme volatility, and the whole concept there is around a different maybe long short strategies, etc.
Yes.
It just means that you are going to have high frequency trading also in some way.
So it is for those people who are high net worth HNI or very high net worth individual, और जिनके लिए 25-50 लाख से कोई फर्क नहीं पड़ता है.
So I think as we are looking through, there are no further questions that have come up, and it's been great. It's been wonderful having your insights on this. From our side, we have two things to share towards the close of the webinar. One is, we wish and hope to see Balwant again talking about many things to all of you. And we also wish to see many more of his columns coming up on taxation that affects the common man. So Balwant, once again, from FPSB side, a big thank you for being with us this day. Thank you so much.
I'm obliged, sir. I'm obliged.